You pulled $20,000 from your 401k, just $20,000. So, why can the IRS sometimes make it look like you earned thousands more? Here's the part most retirees don't realize. It isn't always about how much money you have. It's about the order you take your money out. You can save for 30 years, pay off your house, and do everything right, then still create an unnecessary tax bill because you flipped the wrong income switch first. And once you understand these 3 retirement tax traps, the smarter strategy starts to become obvious. First is the Social Security tax trap. Your Social Security isn't taxed based only on the size of your check. Your other income matters too. So, when you take a large withdrawal from a traditional 401k or IRA, you can push your combined income higher and potentially cause more of your Social Security to become taxable. That's how a $20,000 withdrawal can create the feeling of much more taxable income. You're not actually receiving another $17,000 check. The withdrawal is simply causing more of your existing Social Security to show up as taxable income. Then there's Medicare IRMAA. This is where many retirees get caught because the damage can arrive later. If your income crosses certain thresholds, your Medicare premiums can increase, and Medicare generally looks back at your tax return from 2 years earlier. So, one unusually large withdrawal today can potentially mean higher Medicare costs later. You thought you were taking out $30,000 for a major expense, but the real cost can be much bigger. And then there's the income spike. Taking too much money from your traditional retirement accounts in 1 year can push more of your income into higher tax brackets and create additional tax consequences. That's why retirement isn't just about asking, how much should I withdraw? The better question is, which account should I withdraw from first? For many retirees, the years immediately after retirement can be extremely valuable. Before claiming Social Security, you may have more control over your taxable income. You could potentially use some cash or taxable investments, take carefully planned withdrawals from your traditional IRA or 401k, and consider Roth conversions during lower income years. Then, later, you may have a smaller traditional IRA, potentially smaller required withdrawals, and a Roth bucket that can provide tax-free income. Delaying Social Security can also increase your future benefit, although it isn't automatically the right choice for everyone. So remember this, retirement planning isn't just about how much you saved, it's about how you turn that money into income. The wrong sequence can create unnecessary taxes, higher Medicare costs, and bigger income spikes. The smarter approach is to plan the order before you need the money. Check your projected income, look at your tax thresholds, and consider running the numbers with a qualified professional before making a major withdrawal. Because in retirement, the order you take your money can matter almost as much as how much money you saved. If you want more retirement tax breakdowns like this, hit like, subscribe, and I'll see you in the next one.